The Bitcoin 4-year cycle is dead. I told you so. Now, everybody's wondering, everybody's so desperate to attach certainty to something called the 4-year cycle in crypto. This is because Bitcoin historically has had a 4-year cycle. It pumps for 1 year, it drops for 3 years. And I made a video about a year ago explaining that I'm assigning less importance to the 4-year cycle. And at this point in time, it's never been more clear that the game has changed. This time it's different. And I'm going to tell you why. I'm going to tell you why it's not good to be hooked on models that have been proven wrong. Because Bitcoin is changing and it has to do with institutional money. There's somebody that comes up with a model that works, and maybe it works for 1 cycle, maybe it works for 2, but eventually it doesn't work anymore and people just move on. But that's because human beings, we're pattern recognition machines. Okay, we're desperate to find a pattern in anything, even when there's nothing there. People will look desperately for meaning in the smallest minutia, almost the equivalent of like reading the tea leaves. You know, sometimes technical analysis is right, but other times it turns into astrology for men, okay, for dudes. And so the purpose of this video is that I think the game has changed. I don't think we need to live in this 4-year cycle anxiety world of, oh, we got to sell at this particular date because the 4-year cycle told us so. And it's good to be a little detached. Okay, now I can do some appeal to authority stuff, which I'm going to do. I'm going to show you guys that these other dudes, these analysts from Crypto Quant and Bitwise also agree now because it's far less controversial, because everybody wants the game to go on. Nobody wants to say, oh, the 4-year cycle tells us that it's over right now, because it certainly doesn't feel over. In fact, it feels like it's just getting started. And that's because Bitcoin has done a couple of things differently this time. First of all, like I mentioned around this time last year, Bitcoin has never topped before the halvening, but it did this time. It topped before the halvening. And for people that don't know what the halvening is, it's something baked into the code where every 4 years, the supply, the block rewards that get paid out to miners gets cut in half, meaning the inflation rate gets cut in half, meaning theoretically there's a bit of a supply shock. Now, the halvening is still important. Okay, it still makes Bitcoin more scarce over time. It's not like it's irrelevant at all. And it probably was one of a few catalysts for this particular bull cycle. But the main catalyst, in hindsight, it's starting to seem obvious, the main catalyst was ETFs and global institutional liquidity. Institutional money, serious money. Like money from, not retail, money from guys with billions of dollars, like BlackRock, Fidelity, all the major Wall Street kind of players are now getting into Bitcoin, and Bitcoin's recognized as a global asset class. Before it was just like some weird Beanie Babies, okay, a bunch of weirdos, cypherpunks, whatever. But now that everyone realizes that there's money to be made, that people want to trade this stuff, censorship resistance is a real quality that people find valuable, store of value, digital gold, all these narratives, they're becoming far less controversial. And so these analysts basically say that this time, old whales are selling to new whales. They're not just dumping on retail. Now, I'm sure they are to a degree. People are dumping on retail every time. But big, large players, now when they're selling, they're actually selling to diamond hands that are scooping it up. So the entire 2022 bear crash, you know, with FTX that imploded and people lost billions of dollars. Well, for once, the people on the other side of this trade were the crypto naysayers. Jamie Dimon, JP Morgan, Bug Eater, World Economic Forum types that were telling you crypto was a scam. They were buying your Bitcoin. They were buying your blood and your fear. And if you were scared over the past 3 or 4 years in crypto instead of buying, well, now you're going to have to buy from BlackRock, because institutions own probably, they say it's about 6.5% of all Bitcoin, but with all the lost Bitcoin, they probably own over 10% of the entire supply. And what these institutions do is they just buy and they never sell. And they buy Bitcoin so that they can mint an ETF, which is a stock version of Bitcoin, okay? A version of Bitcoin that's traded on the traditional system. Now, you watching this video, you might not care about that. I don't either. I'd rather just buy the coins myself. But there's $100 trillion in assets, in equities on the stock markets of the world. So to get what's called paper Bitcoin, trading like a stock, you need these institutions to basically just perma-buy. They just buy forever, they hold forever, and they mint the ETF to trade to retail or 401ks or all this global liquidity that wants to get exposure to crypto, but they don't want to actually get a crypto wallet and buy the coins from like Coinbase or whatever. A lot of people just want to allocate a part of their retirement fund from the traditional system, which, I mean, I think the traditional system is dying in general. I don't want to be a part of it at all, but I think differently than a lot of people. So the Crypto Quant CEO, he says that it's different this time because old whales are selling to new whales. He even says sorry for calling the top too early. So this is what you get for listening to people that were so certain of a 4-year cycle. And we've got the Bitwise guy, Matt Hogan, Chief Investment Officer, said that the halving's impact weakens every iteration, and it does make sense. Right? Every iteration, the halving gets weaker and weaker as a predictable metric, and that's because bigger long-term forces are taking over. For instance, the steady flow of money into spot ETFs, growing institutional investor interest, and Wall Street's slow move into crypto infrastructure. along with regulatory progress that began in 2025. So the Trump era is basically making it okay culturally to do crypto stuff in the USA. He suggests that there may not be another super cycle, but rather a steady, sustained boom. And we can just call things whatever we want to call them. Super cycle is such an arbitrary name. I think we're in for a pretty good 2026 even. But like I said, that doesn't necessarily follow the 4-year cycle. So you got to get over that, right? Don't be so hooked on the past because everybody's model works until it doesn't. Of course, we've got stuff like the Genius Act, the stablecoin bill, the anti-CBDC law, the Clarity Acts, and all these so-called pro-crypto legislations. But objectively, we can just see that Bitcoin volatility, look right here, has reached historically low levels versus Ethereum and Solana. ETH and Sol are next in line, okay, especially Ethereum right now. And eventually, all the volatility is going to be squeezed out of ETH too, and it'll be a more structured bid up and to the right, linearly rather than parabolic. But that's why you want to get in on these things while they still have that parabolic explosive growth left. Bitcoin's not attractive anymore. The volatility was the feature. It was the feature that some people thought was a bug because when it dipped 80%, they got scared. They didn't realize that it went up 100x. But Bitcoin doesn't go up 100x anymore. You'll be lucky if it does a 2x from here. So the implied volatility of Bitcoin dropped all the way down to 28%, a multi-year low, compared to newer stuff like Ethereum and even newer stuff like PulseChain, for example. PulseChain's got the really powerful explosive growth factor because it doesn't have institutional buying yet. But PulseChain exists in a regulatory environment where theoretically you could have a PulseChain treasury company come in to buy PulseChain for their bottom line for their business. And by the way, they can use gainpulsechain.com. PulseChain even has a compliant, banking relationship friendly exchange where institutions can actually buy Pulse if they want to, and Hex and PulseX, by the way. Pretty cool idea. I don't know who's going to be the first to do that, but you've got PulseChain and newer chains that still are more pumpable because you want volatility when it goes up. You just don't want it when it goes down, but you can't have it both ways. As the volatility goes down, the explosive up volatility, the growth potential also gets squeezed down. So volatility is lower. ETF inflows are creating a slow and steady drip into the actual price, meaning they're more sustained, more elongated cycles. And this article here says unhedged spot Bitcoin ETF flows show that Bitcoin is now a macro asset. So there you have it. Data shows that real institutional investor money is growing, and now people are accepting Bitcoin as a macro asset, not just some crazy, internet nerd, dark web money. So because such a significant portion of spot Bitcoin ETF inflows are unhedged long only, this indicates genuine institutional conviction. And also now that a lot of the trading is done by like CME futures and derivatives, and all of these institutional money companies can hedge their bets. They can go long and short at the same time. You don't have all these crazy short and long squeezes where a bunch of people are betting on one direction and they get squeezed out and the price shoots up to one side, up or down. But now a lot of people, they straddle, they hedge, they buy longs and shorts, they sell puts and calls. So with all these people trading in the derivatives market, that's a separate thing from the ETFs, but all of these things create just a more elongated, steady growth and lower volatility. So Bitcoin continues to behave like a traditional macro asset, strong correlation to equities. It always has been risk on. People say it's decorrelated. It's not. It's always been risk on. This is not new. But it's more tied to the liquidity cycle, and that's pretty obvious at this point. It inversely tracks the dollar, just like stocks do. So when the dollar is weak, stocks go up, and high yield credit spreads. You've never heard more macro talk in relation to crypto than you have during this cycle. In the past, there was a lot of tech jargon, white papers, a lot more cypherpunk type of stuff. But you got a new era, and this time is different. So the regulatory environment's good. The ETF inflows create a sustainable drip. Derivatives markets and Wall Street, with their billions and trillions of dollars, really, are able to squeeze the volatility out, and the 4-year cycle's dead. Luckily for you, even though Bitcoin is boring, PulseChain is like the brand new version of Ethereum. And Ethereum's about to have a massive run, and wouldn't it be cool if you could get in on Ethereum at stage 1? Ethereum did a 10,000x in its first cycle. Ethereum went from 31 cents back in the day to $3,700 today. What might happen for PulseChain? PulseChain's brand new, only 2 years old. Ethereum is 10 years old. Bitcoin's 15 years old. To keep it really simple, it's all about how few people are in the coin now to how many people are going to be in the coin in the future. Bitcoin's got all these ETF inflows, all these derivatives, all this brand name recognition, but that means it's also got the lowest upside. So look for the newer stuff if you want to make life-changing money. That's why I'm heavily invested in PLSX, PLS, that's PulseChain, and Hex. So if you're new to crypto, newer stuff pumps harder, plain and simple. If anyone's telling you about the 4-year cycle, getting you nervous that it's about to be all over, Don't listen to those people, especially if they haven't already been in crypto for 10 years like I have. If they haven't already made a lot of money in crypto, what do they know about the 4-year cycle or anything else? See you guys on the next video. Oh, and if you want to learn how to do crypto the right way, hexpassiveincome.com, I've got a course for you. If you're brand new to crypto, now's a really good time to learn how to not lose all your money, how to not get scammed, how to buy, how to sell, and do some basic strategies that can earn you yield in this new PulseChain ecosystem. Check that out, hexpassiveincome.com. See you on the next video.